but the QE of us was 8 trillion, the QE of the rest of the world was another 8 trillion or something like that. You're talking about huge sums of money. And we don't really know the full effect of that. And the bond dealers, which Gary mentioned, inventories are much smaller than they used to be, partially because of rules and regulations. And you are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for J.P. Morgan Chase. Not really. I tell people when Credit Suisse went bankrupt at the First Republic, it was terrible for the banking industry. I think we can make everything better, including that, by just changing and modifying certain rules and regulations, letting market makers intermediate more in the market. But to give you a number, like just J.P. Morgan alone buys and sells $3 trillion a day. And we move $10 trillion a day of money. And we're probably a tenth. So the money moving around the world is $100 trillion a day. The money moving around in the investments, this is stocks, bonds, corporates, governments, derivatives, credit, you name it, FX, sovereign debt around the world, 30 trillion. The people who set those long-term rates are those people, including you in the room. It's not the Federal Reserve. They can try to manipulate the long-term rate. They can do what's it called? They do the twist or whatever. It doesn't work for that long. So if you look at economic history, bad things happen. When those tectonic plates shift, it's very hard to see in real time. It is shifting, and this is one of them. I just don't know if it's going to be a crisis in 6 months or 6 years. And I'm hoping that we change both the trajectory of the debt and the ability of market makers to make markets. And also remember, there are a lot of people, going down to Washington who actually like bad markets. And the problem with the bad markets isn't that it's bad for the big banks who make markets. It's bad for the people who raise money, small businesses, asset-backed securities, middle market companies, corporations, the United States government. And that volatility scares people. And then also it happened, markets closed. And you saw that happen multiple times in the last 12 years where you couldn't sell a high yield bond. If you're going to sell a lot of treasuries, you could have had a little bit of issue. So yeah, it's coming.